A lot of my favorite personal trades come from reversals. This is where you're looking to catch the start of a new trend, which means you can get in and then ride a lot of profits out of one single move. In this video, I'm going to be showing you the entry models, the criteria, and the methods you can use to start successfully trading market reversals, so that you too can identify the start and the end of trends and catch all the profit in the middle. Let's get to it. So the first thing we need to cover is the context around reversals versus continuations and where these reversal trades are going to be taking place. There are a couple of phases the market's moving in here. We have a downtrend and then we have a shift into an uptrend. A downtrend is taking place when the market is continually forming lower lows and lower highs, and the breaks of structure are leading through into new lows. An uptrend obviously is the other way round, where these higher highs and higher lows are continually forming, and each break of structure breaks us into a new high. So in a reversal trade, we are not looking to trade through the downtrend. We are not looking to trade through the uptrend. Instead, we are looking to trade that small piece of price action in the middle, the kind of crossover point between the uptrend and the downtrend. And our goal here is to buy into the start of a new uptrend, or in a bearish scenario, it's to sell into the start of a new downtrend. Now, what we're looking for when it comes to trading reversals is the area in price where the market starts shifting from higher highs and higher lows into lower lows and lower highs. So it's this area here that confirms that change in the trend direction. And it's actually this area here that we're going to be looking at building our entry criteria to get into positions. So we would be looking to sell this level to then take the market down into a new bearish trend. Now, of course, as we've said, we can also do this the other way. So if we see a market shifting from lower lows and lower highs, where it's in a clear downtrend, breaking structure against that trend and trading into higher highs and higher lows, then we would be using this area to actually take buys. And the idea here would be to buy into the start of a new uptrend. So these setups are pretty high probability and they are pretty high reward as well, because we're entering into the start of a new trending movement. Whether it's the sell side or the buy side, we're basically getting in early so we can hold this trade for quite some time, as opposed to a continuation trade where we may be looking to take profits once the market starts to bottom out at each one of the previous lows. We are getting in early at this point, not late, so we can actually hold this for quite some time and tackle some of those previous swing highs, or in a bearish scenario, swing lows that the market formed in its previous phase of trending price action. So that is an explanation as to what reversals really are. We're looking at that crossover point between uptrends and downtrends, and we are looking to get in early to catch the momentum of a new trend. Let's take a look at the entry model that we're going to be using for our reversal trading strategy. It looks just like this, and it's actually very simple. In the case of a downtrending market reversing into an uptrending market, this is where we would be looking to buy. I want to explain this entry model to you from the beginning, so let's first consider the buying versus selling battle. When there is more selling volume coming into a market, whether that means there are more sellers or just more units being sold than bought, that drives a market down. Because in order for people to buy into a market, we need to see demand. If there is no demand to buy at this price here, then sellers have to lower the price for buyers. And it will continue to move like this until buyers are happy to actually purchase units at this price. Now, of course, some people will be purchasing through these levels, but we need to see significant control coming in from the buyers, which means we need to see all of the sellers selling out of their positions and the buyers actually happy enough to take positions that the market starts to shift to the upside. So when the market moves from lower lows and lower highs, formulates its low, and then gets a big drive up, which breaks structure and creates a higher high, this is where the buyers have taken control. Now, when we see buyers take control of a market like this, forcing a leg up in the market to create a new high, a break of structure, this is where we can happily start to look for buys if the market is to pull back to where we want to buy from. That area for buys is going to be just here. We're looking for, after a new high is formed, a pullback in the market to return to a discounted price level to buy from, and then we will be looking to get in with the new control from the buyers. So taking it back to that buying and selling theory, we don't want to buy during a downtrending market because we know the sellers are in control. But when we get that shift, this here indicates to us that the buyers are now controlling the market. So buys are the smart way to move. So we would then buy upon pullbacks into discounted price regions to get the best possible execution, and we can continue moving the market to the upside, just like what you see here. This allows us to catch the start of new trends and get super pinpoint entries for our long-term positions. Now I'm going to show you a few of the different concepts. I'm going to explain to you what this is and what this is, and then we'll go and take a look at a few reversal examples. So let's get to it. So in this section of the video, I want to introduce you to all of the different concepts that we use inside of reversal trades. Realistically, there are only really 3 that we need to be aware of. The first is market structure, the second is supply and demand, and the third is market efficiency. So market structure refers to the direction of the trend, as we've already discussed. If a market is making lower lows and lower highs consistently, this is a downtrend. And if a market is making higher highs and higher lows consistently, this is an uptrend. Now, as we mentioned, reversals are the area where the market makes that first initial shift. And our idea is to buy reversals to lead into new trending directions. So by taking a look at this example, the first thing we can see is that we have a break of structure just here. So after forming lower lows and lower highs, we created this low here, and then the market went up and rallied to create a higher high. So this is the first sign where we're seeing those buyers take control, okay, closing up at this high. This indicates to us that the downtrend for now is over and is ready to start trading into an upward leg of price action, which allows us to look for our opportunities to buy. The second thing we want to consider is market efficiency, also known as imbalances. So the market trades in 2 phases, efficient ranges and inefficient ranges. An efficient range, for the record, is something like this, where we continually move down and pull back in a very neat manner. Every time we open a supply zone, the market comes and retests that supply zone. There is no open price ranges left open inside a piece of price action like this, okay? Every time we push down, we pull back up to fill the range before pushing down again. Now, an imbalanced price range or an inefficient price range is actually just an open gap in price. So if we take a look at where I've drawn this arrow, ignoring this piece of price action for now, once we had this big drive up, we opened what we would call an imbalance from this candle here, up at the top, all the way down to this candle here at the bottom. So here in this candle, we have an imbalance or an open price range. Here we have imbalance or open price range. This candle is actually retested wick to wick there, but we have more imbalance here. So this candle, and this candle are imbalanced. We're going to be considering all of the imbalance. So we need to consider that this is also an imbalanced price range. Now, when we see an imbalance, what we are generally expecting to see is before the market continues moving in this direction, a fill of the imbalance. So we're not trading this like the newer mentioned FVG that people are trading nowadays. This is an imbalance, the original version of the FVG concept. We don't look to trade out of imbalanced price ranges, but we look to see them filled. Now, to show you what I mean here, if we pull this imbalance all the way over, the imbalance is everywhere above this wick, okay? Above the line that I've just drawn on. As you can see, before the market makes its larger movement to the upside to create a new higher high at this point, all of the imbalance that we created through this price range here has been filled with this push down and this reversal that we see in the low down there. So then the third and final concept is supply and demand. Supply and demand refers to zones that we mark at the low or high of significant movements in the market. This one down here is going to be a demand zone. What it indicates is an area of institutional demand or institutional willingness to buy. The reason that this shows that is because here we have this kind of sideways candle, or basically the reversal point from down to up before a significant drive to the upside. This tells us that this price range, pretty much between this low and this high, was seen as a good level to buy from for institutional participants. And we saw significant amounts of buying take place here, which is why we had such a strong move to the upside from there. Our simple theory is now, if this was seen as a good level to buy from before, it will likely be seen as a good level to buy from if it is retested again. So we look to buy from these demand areas, understanding that they are seen as very favorable or discount prices for market participants to buy from. And we just want to join that flow and make sure we're getting in around the same discount price levels. So to pair the 3 concepts together, we are first of all looking for a market that is moving from lower lows and lower highs, shifting into higher highs. Then, in order to buy from a higher low, we want to find an imbalanced price range, which is going to be this area here, with a demand zone beneath the imbalanced price range. Once the imbalance is filled, we then want to buy from the demand zone. And this is always generally going to be taking place using buy limits. The reason for that is we don't need to use any confirmational entries because we already have our confirmation entry. So a confirmation entry, if you haven't watched any of my other videos, is a piece of price action that looks like this, where we are looking for the market to come into our demand zone, and then we are looking for the same thing we've pretty much just explained of the market breaking from lower lows and lower highs into higher highs and higher lows, and we will then look to buy here. Now, the reason we don't really need to use this fractal confirmation is because we've already got this confirmation forming here. So we don't actually need to do this to get our entries. We can just fire straight into the trade with a buy limit once that level has been met. We have our higher time frame confirmation. All we want to do with this imbalance and demand format is use this to get into our trades. So our actual opportunity would look something like this, with a buy on the demand, a stop loss beneath the swing low, and then a target extending either into the previously formed swing high, which would be this level here, or extending even further. Here we have an imbalanced supply zone. That's a good way to target here to continue the larger trend. And that is a hypothetical example of pretty much exactly what a confirmation entry is going to look like when you're trading it, and exactly what some of the entries that I'm going to show you now look like as well. So we look for that reversal from lows into highs, find the imbalanced demand zone, and then use a buy limit to buy once the imbalanced demand zone has been retested. Nice and simple. Now, in the instance of a bearish market, we would look for the same but flipped upside down. We want to see a bullish market that is breaking into lower lows, and then in order to sell the lower high, we want to find imbalanced supply. So the only thing that really differs in a short scenario is we're not looking to buy demand, we're looking to sell supply. Supply zone is exactly the same as a demand zone, but preceding a large selling move rather than a buying move. So this candle before the large impulse down is exactly where we would want to sell. And then when this supply zone is met, our sell limit at this level would get us into a trade with a stop loss over the swing high, like so, and a target down at any clear imbalanced price range, such as an open imbalanced demand. So that is the format, the concepts, and the way that we are going to be executing pretty much the entry model laid out for you in terms of buy setups and sell setups. Now let's go and take a look at two more examples of reversal trades so that you can see what they look like in different market scenarios. So here's an example of a reversal trade taking place in a market. We're looking at Euro USD. Here we can see over to the left, we have an area of demand over here, okay? Now this is important because this is the context behind our trade. You don't just want to take any random reversal from anywhere. It generally is going to come from an area of demand somewhere in a previous trend in the market. So we can see that there was a clear uptrending market, but this has since given way. This demand zone here is the final inefficient demand zone. So you can see from this low onwards, we have an efficient price range where every push away has been followed by a pullback up until this demand here, where we had a drive away and an imbalance left open. Now this has then been filled after the market shifted into a downtrend. So we saw the market moving up, break into a downtrend, retest this area just here of demand, and now we're starting to see a reversal coming back underway. So this would be our reversal execution, and it's coming from a demand zone. Let's break down the actual format of this entry. So we can see this would be where you'd be taking continuation trades or pro-trend trades throughout this falling market. But when the market comes down to this point just here and formulates a lower high before the lower low, we create a break of structure through this high. So to mark out the trend, we basically come down, form our lower high, lower low, and then have a break of structure to the upside, okay? So our final bearish break of structure takes place here, and then our first bullish break of structure, which actually reverses the market direction, takes place here. This is where we start to break structure from bearish to bullish. If we then take a look down at the extreme, down at the low just here, we are now looking for, as discussed, a pullback to then buy from. We want to get a discounted buy, discount price level. So we don't just want to immediately buy into the market right here, where the market has actually created this new high, because this is not a prime entry. We're going to want to see a pullback to get a discounted buy, to get the best possible risk reward and best returns from this trade. So we would use our demand zone tool to find our imbalanced demand zone. Where's that going to be? Well, there is no imbalanced demand here. This is an efficient range. Then there is imbalance left open here, leading us towards this candle as our demand. So my demand zones are drawn as the last candle before the impulse. So the final candle that's kind of moving sideways or slowly before the impulsive move begins. The impulsive move being the strong imbalance candles that create the change in the trend. So we're now simply looking for a pullback towards this demand to buy from. And as we discussed, because we've now seen the conformational shift, we don't need to wait for any additional confirmation inside of this area. This, for example, is just simply unnecessary in a trade like the one we're looking at. So what we would do is place a buy limit just here on this demand. Our stop loss can generally go, first of all, beneath the swing low, or potentially, such as in an example like this, beneath the demand. Now, why could we trust putting this under demand? Well, that's because if the market is able to come under this low, there is no reason with this wick that the market should react inside that level. So if we get a push down like this, we will not be expecting the market to trade higher. This would actually be seen as a bearish sign because the market has evidently shown this demand is not strong and there is no more demand here to drive the market higher. So we could actually go with a nice refined stop loss to get maximum reward out of this trade. Now the thing with reversal trades is we are joining in at the start of a trend. So we can actually run these trades for a very long time. If we're anticipating that this bearish trend is now going to be reversed, we could realistically look to trade this all the way back up to the structural highs. So depending on what kind of timescale you want to be trading on, because I know a lot of people don't want to hold trades for weeks or months, you can just simply target previous swing highs. And actually, because reversal trades lead back into some price action that's previously taken place, such as, of course, this downtrend, we get to see a lot of different supply zones and potential swing highs that we could use as targets for this trade. So just to show a few here, we could look at this for target 1, this supply zone for target 2, this supply zone for target 3. You could even have this supply up here as a 4th target, and then of course the swing high would be the final 5th target. Now I don't recommend you partial take 5 times because by the time you get up here, you'll have such a small amount of your position running that it's simply not worth it. But I'm highlighting this possibility to show you that whether you want to take trades that you hold for a few days, a few hours, or a few weeks, you can actually be very dynamic with your targets. You can go for smaller targets to lock up profits faster, or you can really swing these trades out and play them as a true reversal, holding them all the way through previously trending markets, okay? So now let's run this trade through. We're gonna put it on 10x speed and just see what happens. You can see here, we get tapped into the trade. The market pulls down. Our initial execution would actually be right as the zone is tapped. The market rejects inside of this zone, as you can see, so we have wicks continually pushing us back up, indicating that buying pressure is kicking in under these levels, and then we do start to see that significant movement to the upside. As you can see, the point that we just discussed about using different areas for targets, this initial movement would have driven you through to target 1 and target 2 pretty quickly, then to target 3 and 4 after a couple more days, and then if you were holding all the way out for the maximum target, you probably would be holding this trade for a good few weeks, in fact almost a month in this example. Now even if you did hold this for a month, you've made 11% return. Think about that. If you can make between 3 to 5% per month consistently, even 2%, you can make tens of thousands of dollars from your trading. You can actually make 6 figures a year with as little as 2 to 3% per month using funded capital. So if you did this 11% trade on a $300,000 account, for example, over the span of a month, you would have made $33,000 in returns, which obviously is worth just holding through. It's not like you have to be running these trades in a day or just a couple of days if they can generate such large profits. And that is the beauty of reversals that continuation trades simply don't have. When you're continuation trading, such as selling into the market here, yes, you can run it down a little bit further, but you never know at what point this market is going to reverse. The market trend is already well underway, and the likelihood of this ending sooner is faster than if you're getting in at the very start of a trend, such as right up there, or for this trade example. So that is trade example number 1, a very simplistic entry. We've done this on the 6-hour time frame. I'm trying out some random time frames really just to kind of switch things up and show you that this is possible across all time frames. This doesn't have to be done on the 6-hour time frame. This could be done on the 6-hour, the 4-hour, the 1-hour, the 30-minute, the 15-minute, the 10-minute, the 5-minute, or even the daily time frame. The concept here is fractal. Structure, supply and demand and imbalance works the same on all time frames. So whether you want to be doing this from a higher time frame perspective to take very nice, neat swing trades like the one I've showed you, or you want to be doing this on a lower time frame basis to intraday trade on the 5 and 15 minutes. You can do whichever you want using these concepts. So now let's go take a look at a low time frame example of how to trade reversals. We're going to be looking at the 5-minute time frame to show you that this happens on the low time frames as well. So for our trade context, we see an area of demand here. Look previous to that in these wicks, we have absolutely no imbalance left open through this price range up towards this imbalance between the demand here and this swing low. So this is a demand that we'd be interested in seeing reactions from if, of course, we retested it. If we take a look at where the market now is, we have indeed retested this level. Now this retest is coming at the end of a downtrending phase. The downtrending phase pretty much starts here and runs all the way down to the point just here, where we're creating lower lows and lower highs in the market, okay? Now, upon coming down to retest this low here, we've seen the market trade into a new higher high. So we've had a break of structure just here, which indicates the market could indeed be changing direction. At this point, because we've seen that market reversal, where pretty much these lows here have broken, retested demand, and then rallied to break structure, we could look for a buy, understanding that the market is likely to now change direction. To buy, we want to see a discounted price level. So we want to make sure that we're buying from an imbalanced demand zone and not just immediately buying into the market because our risk reward won't be so good. So considering what we've discussed about imbalances so far, do we have imbalance here? No. Do we have imbalance here? No. How about here? Also no. But then this candle here, we actually do have imbalance above it, right? So there's an open price range here. There are no open price ranges anywhere below that level. So our clear imbalanced demand zone is going to be this last candle before the impulse, the last candle before we went and created that imbalance in the market. Now, because there is an efficient market here, once again, if the market was able to trade beneath this demand zone, there would be no reason for us to be in a trade, so we don't need to clear the swing low with our stop. If the market comes under this demand and trades into this efficient range, it is highly probable that it will actually just stop us out and that the market won't reverse how we want it to. So if we were to place our trade here, we would go with a buy limit. We would have our stop beneath the low, understanding that if this demand zone fails to hold, our trade is invalid and we don't want to be in it anymore. And then for our target, we're just looking for imbalanced supply zones above. We have one just here, which if we take a look at the range beneath, we have an efficient supply, efficient supply, efficient supply. So this is the next considerable imbalanced supply zone, okay? That makes this a very simple and easy target. If we are reversing, we are highly likely to continue trading upwards through the efficient range to at least fill this in efficiency. So that is what our trade will look like in this example. As you can see, it follows the exact same format as we've looked at previously. We have our low, lower high, break into our final low, and then a push up into a higher high. Now in this one, we don't pull all the way back for a retest because there's no imbalanced demand down here. But we do pull back to the closest imbalanced demand to get the most secure and highest probability entry possible from this leg of price action. So this trade could return 4.2% for every 1% risked if it worked out. And obviously if it does lose, it's only going to be a 1% loss, which is nothing that can't be managed easily. Here you can see the trade played out from start to finish. After running through all that context and letting the trade do its thing, we see that this trade runs all the way through to the target pretty quick. This is a trade that was taken in London session and it took 2 hours and 20 minutes to play out. So that's a 4.2% return trade in 2 hours and 20 minutes. At $1,000 risk, that is a $4,200 trade. If you were trading, for example, a $300,000 account, that would be a $12,000 position secured in just 2 hours, okay? And you can do that with funded capital without having to use, obviously, massive amounts of your own money. So that is a reversal trade on the 5-minute. And as you can see, this works on pretty much all time frames. So whether you want to day trade or swing trade, this approach will work for you. Now, one very important thing, whether it's reversal trading, continuation trading, or any other approach to the markets, is that you need to systemize your technical process. You need to turn this information into a strategy that you can repeatedly follow so that you know you have an edge in the markets. Now, I have a course which is completely free. There's a link to it in the description. It's called 7 Steps to Profitable Trades. In there, I'm going to show you how to build your own first successful trading strategy and how to build upon that strategy to improve your returns, become a better trader, and make more money overall. So check that out if you want to. As I say, it's 100% free. And if you don't want to do that, there's a video somewhere on the screen, which I know that you are going to love. So thanks for watching. Enjoy the free course, enjoy the next video, whatever you pick. I'll see you in the next one.